do you know what your credit score is and why it matters? Let's dive right in. A credit score, in simple terms, is a three-digit number that lenders use to evaluate your credit worthiness. It's like your financial report card, showing how well you've managed your money and debts. The importance of knowing your credit score can't be overstated. It's the key that unlocks many financial doors. Whether you're applying for a mortgage, car loan, or even a credit card, lenders look at your credit score to decide if they'll lend you money and at what interest rate. A higher score can lead to better loan terms and lower interest rates, saving you a significant amount of money over time. So it's vital to keep an eye on your credit score, understand what it means, and take steps to improve it if necessary. Remember, your credit score is more than just a number, it's a reflection of your financial behavior. But what exactly is a credit score, you may ask? Well, in the simplest terms, a credit score is a three-digit number that represents your credit worthiness or how likely you are to repay borrowed money. It's like a trust rating given to you by credit bureaus based on your past financial behavior. Now, credit scores can range from 300 to 850. A score below 600 is generally considered poor, while a score above 700 is seen as good. If you find yourself in the excellent range, that's anything above 750, you're doing fantastic. So you see, a credit score is more than just a number. It's a reflection of your financial habits and trustworthiness. And just like in school where you aimed for those high grades, the same principle applies here. Your credit score is like a financial report card, and just like in school you want it to be as high as possible. You might be wondering, how is this score calculated? Well, let's shed some light on that. Your credit score is influenced by 5 key factors. The first and most impactful is your payment history, which accounts for about 35% of your score. This looks at whether you've paid your bills on time or have any delinquencies. Next is the amount of debt you owe, making up about 30%. This includes the number of accounts with balances and the proportion of credit limits used. The length of your credit history contributes 15%. The longer your credit history, the better it is for your score. New credit inquiries and recently opened accounts make up about 10%. A large number of these can indicate higher risk. Lastly, the types of credit used constitute the remaining 10%. A mix of credit types, such as credit cards, retail accounts, or mortgages, can be favorable. Understanding how your score is calculated can help you make smart financial decisions. So let's get financially savvy. So why does your credit score matter so much? Let's dive right in. Your credit score is like a financial passport. It can affect various aspects of your life, often in ways you might not even consider. For instance, when you apply for a loan, lenders look at your credit score to determine whether you're a good risk. A higher score can mean better loan terms and lower interest rates, saving you potentially thousands over the life of the loan. But it doesn't stop there. Landlords may check your credit score when you're trying to rent an apartment. Some employers even look at it during the hiring process. Having a good credit score can open doors to opportunities that might otherwise be closed. Improving your credit score can lead to better financial opportunities. It's like giving yourself a financial upgrade. Better credit card offers, lower insurance premiums, even better job prospects. Remember, your credit score is a key indicator of your financial health. Keeping it in good shape opens up a world of opportunities.